When we look at the three major investing strategies, value investing, growth investing, and technical analysis, one of them is value investing. It's a very popular way to invest. You might have heard Warren Buffett or other real famous type of investors, and they use a value investing approach. And the whole idea of value investing is that you're looking for these hidden gems. You're looking at something where the market is not, valuing it correctly. And the idea is you're really trying to give yourself a cushion and buy low so you can later sell high. And these value or contrarian stocks, you're going the opposite of the market, contra, or they've kind of come down in value. So you're looking for beaten down stocks where the prices have gone down. And the idea is that the market has undervalued it. You feel that there's some type of news or something happened. Maybe there's some recent bad news, or there's a big sell-off, or they missed their earnings by a little bit, or they've had a couple bad quarters. The company has really struggled, maybe in the short term or recently, and thus their stock price has gotten beaten way down. But if you look at it and you're looking for companies that where the long-term fundamentals are good, their business model is good, you believe in what they're selling, their products or services, future markets might look good too. So you're looking for these hidden gems where the market's really beaten down the price, and you're looking for but long-term, I can buy low here on this beaten down stock, and then I can then invest in there, and then it'll grow from there. Now, one of the challenges, of course, sometimes they never do grow. They're beaten down for a reason, and they continue to go down. So you got to watch that you're not on a sinking ship. But the whole idea is that you're looking for these hidden gems. And one way to look for them is looking at some key ratios. One, of course, is in the news. You want to hear things in the news and a stock going down, and you start looking at their range of pricing maybe over a 52-week period, and they're towards their low end. But you can also look at some key ratios too. One of them is that they'll run compared to the average in their industry and the market, a lower price to book type of ratio. You're looking at what is the intrinsic value? What is the value of this company? What's the book value of this company? What is the value of the company if you were to add up all its assets and deduct its liabilities, the equipment they own and all this different stuff, the patents they might own, and say, okay, well, the company's worth X, and the price has come down so far that it's really close to this X price of the value if you just sold off the company. So it's giving you that cushion. Sometimes you can even go below the intrinsic value of the company, below some of the assets. That's rare, but it can happen. So the idea is you're looking for a low price to book things. You're looking for that price of that stock. The price of the stock has come down compared to its assets. So look for price to book. Another thing is, very famous ratio, you see it everywhere, is the PE ratio, or price to earnings ratio. So you're comparing its price to its earnings and looking at that ratio, and that would have a lower PE or a lower price to earnings ratio. So if a company has a PE of 15, another one has one of 8, well, the one with 8 has a lower price to earnings. And the idea, those stocks are undervalued. Their PE ratio is lower compared to their earnings. So you'd be typically looking for lower PE ratio stocks within a particular industry or something that you know of that you're investing in, using the stock example. And lastly, a lot of these value stocks, if not most of them, also will pay dividends. Sometimes you have companies that are really good, stable, long-term companies, but they're considered in the value category because they're not in this explosive growth phase, right? They're not Google or someone who's really explosively growing, or a small tech startup or a biotechnology stock that's growing. They've been maybe around for 100 years for all we know, and they're not experiencing that growth phase. So maybe somebody like Coca-Cola, for example, or Coke is still growing well. It's growing internationally, doing very well in many cases. So it's a long-term growing company, but it's not like a tech company that's really growing fast. And so those companies will tend to pay a dividend, right? So as part of sharing money back to their owners, the shareholders of common stock. That's basically you. So you're looking for companies that are, a lot of times will have dividends, and that they'll have a high dividend yield as far as a ratio. Yield being, looking at that the price versus the dividend, and you're going to get a percentage on that. So if it's something like a dividend yield of 3%, that's like interest rate. It was a way to think of it, where you're going to get 3% of your money if you buy that stock. Something that's at 4% or 5%, even higher, you're in effect buying and getting that dividend at a higher payout. And that's all assuming that they've got the money to pay out the dividends. So you look at payout ratios and other things. Look at the dividend investing section of the course here. Have a lesson on that. So look at that lesson if you're interested in value stocks and looking at dividend investing. But the idea is that you're going to buy these stocks that where the price is beaten down so far that their dividend yield goes up. So you're basically buying a little bit of cushion. You're buying some, a stream of dividend payments, assuming the dividend doesn't get cut. you'll have that stream, and maybe if you get some growth on the dividend, that's even better. So you can get the price appreciation by getting the stock beaten down, and you can get the dividend appreciation assuming that all goes well. And the whole idea is that you're looking for future. You're looking towards the future growth, future cash flows, that money's coming in and that cash is flowing in the future. And sometimes with value investing, it's hard because you're going against a little bit of the market. You're the one who's saying, no, I think that company's good. I think that stock is good. I'm going to take a chance on that company versus a growth stock or a high flyer where everybody's kind of buying into it. You're kind of looking the opposite view. And the idea is you're buying with a little bit of cushion. You're buying it devalued. You're buying it with that future in mind. And the whole idea is you're buying good companies that can deliver great returns in the future. And that's value investing.